For our COBT viewers and listeners, welcome to installment 2 of NAPE Week. When we were thinking about the menu, we knew we needed to talk about the asset markets and what's going on with oil and gas properties, investing, auctions, just all those moving pieces. And Mark Castiglione is with me here today. And Mark said, we got to get the RBC guys. And I said, you're absolutely right. So we reached out to Scott Richardson and Craig Lande, and they graciously agreed to visit with us today about the markets, what they're seeing. You guys do a spectacular summary of what's going on in the markets, but you've also been doing it for a long time, so you've got some great perspective that we can kick it around with today. But thanks for coming by, guys.
Thank you.
Yeah, thank you.
How's your NAPE week going so far?
Been sober this week so far, so far so good. We've handed those batons to the young kids.
They're somewhere.
I was at home at 8:30 yesterday. Felt
Don't
fantastic.
kid yourself. He's already hit the Four Seasons, no doubt. So.
But the numbers, I guess, it sounds like the numbers are as big as ever. But maybe that's one place to jump in, guys. Is there's a lot of conflicting things in the macro right now. You'll get a little bit of the oil overhang, but it keeps holding up, and then you get the gas zigzag, based on the weather. You got this lower 48, like, are we running out of inventory thing? And then you listened to David Batt yesterday, and it's like, we've never been more productive. So there's just a lot of forces going on. What does that mean? And Scott, I should say, you're not just you see A&D, but you see all of energy investment banking at RBC. What does this mean for capital flowing in to assets, investment mentality? Just talk to us any place you like on this market we're in.
No, it's a really interesting market, and I'd say the last 6-9 months dramatically different than the previous 4 or 5 years. If you go back to 21, 25, all about oil, all about private equity selling, all about strategics buying, fairly stable market, and the market has really flipped in the last 9 months. And I would say right now the majority of deals that are done are gas, and we're starting to see international companies. We hadn't seen international companies since 2000 to the Chesapeake JV era, but we're starting to see a lot of Asian companies buy Gulf Coast deals for LNG linkage. We're starting to see non-traditional buyers. We're seeing companies, like Citadel come in and just buy gas, in the Haynesville. We're starting to see, the MLPs are back. It's just renamed ABS. Over the last 12, 15 months, ABS-backed buyers have bought 25% of the market. And so, people look at the softness in oil right now. We're oversupplied. And I think gas was $2.90 this morning. And it's feeling, it's a great time to sell. What about valuations? And valuations are definitely biased to the seller right now. And there's probably 3 or 4 reasons. Number one, as you said, we are running out of inventory. In the Permian, we've drilled a lot of the easiest stuff in the Midland and Delaware, and so now we're drilling the Barnett, the Midland, the Woodford, in Delaware. So we're starting to see companies that were very, very Permian focused, U.S. centric focused, now having to expand either in other U.S. basins, Canada, South America, obviously, Africa. Private equity has been a big part of this market. In 2018, I think we had $65 billion of private equity with 250 different portfolio companies. Today, we're down to about 50 private equity portfolio companies, 45 billion in capital. So when there is a deal that comes to market, there really is a scarcity premium that's being paid, and the valuations that you're seeing are very sporty. And it means companies are not using strip pricing; they're really leaning in to the back end of the curve. They're giving value to prospective zones. And they're being super aggressive. We've never seen more aggressive bids between the first bid and second bid, and now we're starting to see preempts. You just never really would have saw preempts, but again, I think there's such a fear that there's going to be such a shortage of deals that people have been very, very, very aggressive.
This is. I mean, you two guys are fascinating because you've done it for 25 plus years, and you've done it together. So longtime partners. So your history in all this is incredible. I was wondering, Craig, when Scott mentioned this ABS tool that is clearly such a hot tool right now, would you mind explaining that one to the uninitiated? Because that really does seem to have changed the market dramatically.
Yeah, I guess it's a product, and actually Rusty Hudson from Diversified spoke at our Houston Producer Forum luncheon, lost track of the days, yesterday. And they were really kind of the first to implement that a handful of years ago. And, as he buys really high PDP stuff. And so that's sort of got some traction over the last few years. It's become sort of what was a niche market, seems to be expanding, is, as everyone drove out of fossil fuels, before COVID, and certainly after COVID. Now fossil fuels is cool again in the last few years. There's a lot of money coming in the industry, and a lot of that is from insurance companies, very low cost of capital. And this was a way to basically lock in investment grade type cost of capital for very, like Scott said earlier, MLP is kind of the ABS is the new 3-letter word for MLP. So I think that cost of capital is really allowing these guys hedge out a long time, but it's allowing the handful that do it right now, and there seems to be a growing list of others that are trying to attempt to do it on more PDP heavy deals, but there are those now that are even looking at development and have operating teams. So that thing is evolving each and every day. And so they've been a very aggressive bidder. As Scott said, they're 20-30% of the market. It looks like they just bought another big deal here recently. And it's a real threat to private equity. I think private equity is trying to understand how to be competitive to that. Now, again, we're behind the curtain, so we also see that ABS does not win everything.
Mm-hmm.
It's kind of like the MLPs. You were with an MLP. I mean, you guys won a lot, but you didn't win everything, and so you keep playing the deals. But it is frustrating for some. But there seem to be deep pools of capital now, and seem to be playing a lot of deals.
In the valuation, so, historically on sort of low decline, mature stuff, just spitballing PDP 15%. Now, with the ABS guys, we're seeing valuations, below PDP 10, PDP 9, PDP 8, because, they're getting investment grade ratings from a rating analyst. They're hedging 7-8 years out, and really no debt constraints. So, typically, normal public-private companies are not going to lever the balance sheet more than 1.5 times. These guys have no constraints on leverage.
That's fascinating. So what would you say, what percent PDP in an asset would make you think, okay, the ABS guy is going to take this?
Yeah, I'd say when Rusty started doing it originally, it was sort of, again, MLP, sort of 80% plus or minus type of asset, very mature asset with a relatively flat decline and all the attributes the MLPs used to chase. We've seen that model go from that to much more aggressive type things, or again, with maybe steeper declines and some things like that. I think some people are willing to, they're able to backstop with equity, and maybe some of it isn't ABS-able, but they'll warehouse it for later on when that PDP matures. So that seems to be the mouse trap right now. So again, you just, that pool is so deep. I would say there are deals we have now that normally you wouldn't think an ABS buyer, but you want to not tell them they can't, and they seem to be trying to find a way either to do it on their own, or to the extent it is to maybe a little bit more undeveloped, is to partner with someone that would really like that undeveloped and not all that PDP.
Oh, that's fascinating. So when you guys look at this market, Mark, sorry, give me one more. Then you're
good. You're all good.
If you look at this market, and I mentioned you guys have been doing this for 25 years. Scott, you mentioned the JV era. that we all lived through. You mentioned both the MLP era, and then there was obviously the basins were expanding excitement all through there. What is this market the most like? Like, is this one of the, like, how do you think of this one relative to historical markets?
I think, I we're going back to the 80s.
We're doing some history here.
Yeah. I wish it was 25 years for me. It's been 42 years for me.
Oh, gosh.
But no, it's really unique in that, if you look at, the large caps, there's only 10 left. And, a lot of the big exploration plays in the deep water Gulf of Mexico, North Sea, Alaska, is gone. And so I think, we're gonna see exploration come back. We're seeing, we have a big Canadian business. We're seeing all the U.S. companies that sold out of Canada 10 years ago now looking at Canada. We have companies looking at Greece. So I think it's sort of a unique time. But, talking with investors, it's still not getting the value that we think. If you look at the yields that our industry generates, it's better than any other industry, whether it's dividends or repurchasing stock, clean balance sheets. But the industry is still trading at 6 times. We're still 3% of the S&P. I do think with the recent AI exuberance or whatever you want to call it, we're seeing investors pivot back to energy. And I don't know what happened today, but I think up through yesterday, we're up 20%. It's the number one performing index, and so I do think you'll see flows come back to the industry. But right now, I think we're still looking for respect.
First of all, it's a real pleasure to have Craig and Scott with us today. They're longtime friends, known them for a long, long time. Worked with them and then have bought stuff from them as well. And so it's really great that you all could be with us today. You talked a little bit about international. And what's interesting to me on the international side is we've got international dollars flowing in and U.S. dollars flowing out internationally. Would you mind speaking to, and congrats on you guys advised SM on their sale yesterday, and obviously Mubadala is the backer of Cateris, who is the buyer on that end of the deal. But you mentioned Asians, you got Middle Eastern buyers coming into the U.S. How is that affecting the market? And what you kind of alluded to, price decks and things like that. Yeah. But how do they approach that? Those purchases.
So when we talk about international, mainly Asia, it's primarily gas linkage to the LNG chain. And if you look at all the deals that have happened internationally, for the most part, have had some LNG linkage. I think with the current administration, I think there is an attraction in the U.S. to invest in the U.S. industry, and I think we'll see it more. I think the ESG pivot 10 years ago away from fossil fuels, I think we're seeing that sort of erode. We've seen how Chevron and Exxon have sort of differentiated themselves from BP and Shell. We're starting to see the European integrateds now lean back in to North America, where they view it very politically secure. So, but for the most part, it's been gas. From the other way around, the U.S., it's been more oil. And, we're seeing, obviously 11 billion barrels in Guyana in 2012 was really the start of all this. And then, we've seen Apache in Suriname. We've seen EOG with some success in Abu Dhabi. Lukoil, I don't know if the deal is done now, but a lot of U.S. private equity looking at these Eastern European assets. And, I think it's just a shortage, of opportunities.
Yeah. I was thinking, Scott, as you were talking about public company valuations, E&P companies, Craig, I got to get you in here too. It seems like the valuations in the private market are better, much better than your average public market valuation. Do you guys mind talking about that?
Yeah, I'll talk to the private, maybe Scott, you chime in on the public guys and why they're trading. But I think, to a lot what we talked about is, I know every banker and all the markets beating a dead horse about the scarcity of opportunity, which is real. I recall back in the day, we probably did an average 150 to 200 deals a year, back when you were doing this, and average deal size is probably $200 million. Now you're doing 50, 60 deals a year, and the average deal is $600-700 million. So the deals have gotten bigger, and I think again, there's very much fear, certainly on the public side from an inventory standpoint. I think if you look at whatever you use, Inverus or whatever you use, your own technical, that an IR deck looks great. There's a lot of inventory, but when you drill down of what really is core, everyone probably has some sort of problem. If you're Diamondback Conoco, you're probably blessed with a lot, and you probably have less of an urgency or problem than some of the smaller caps. So it feels like that isn't going away anytime soon. It feels like in a lot of these companies, the publics have levered up to some degree. You remember coming out of COVID, everyone wanted to stay around 1 times levered, and those of us that have done so well 3 times used to be cool, right? So now people have scooted that up to 1.5 times. But what the market is doing, they're rewarding the inventory capture and fine with the upscale of leverage, knowing that, hey, by the end of the year, we'll have it paid down to 1 again. So I think that has become really important. And since there's so little of it, you see guys that really don't have an inventory problem saying, well, this is core, and it's one thing, I need to capture it while I can. Mm-hmm. And an ancillary effect is it blocks one of my competitors out from getting it. And so we've seen that approach. So I think on the private equity side, which Scott hit earlier, is there are fewer teams with a lot of dollars. So there's fewer teams, and they're wanting to chase bigger deals. So a lot of elephant hunters out there. And so everyone talks about the public's having a hard time finding inventory. Private equity hasn't had any more of a picnic to find opportunities. So we've seen them be more aggressive, probably I've ever seen in my career. The cost of capital hasn't changed. And then you throw in the ABS guys, you throw in the international guys, you have kind of 4 buckets of demand for few opportunities. So the lean-in factor you're seeing right now, you asked about the difference, back in the shale days, we were all blessed, 2010, 12, 13, we made a lot of hay because you almost didn't need one well to prove anything. It's like, we're just going to spend like drunken sailors. And so that got fixed. So the plays have matured now, and now the internationals have come back over. It didn't work out so well the first time because a lot of those were around some plays that didn't work out. But now the plays have matured. The geologic risk is a lot smaller, and you just don't see that many opportunities. So I think that's why you're seeing, and I think when you get to round 1 of a bid process, people in the old days, there's 100 more opportunities if I miss this. These days, people are looking at, hey, I'm in the mix. I was one of 100, now maybe I'm one of a handful. I get to go in because you know what? I look above. There ain't nothing else out there that I may want of in the near term. And then you're seeing the lean-in factor really take over, and then the valuations hint you're seeing. So it really has been a tremendous market from the sell side from that perspective. And obviously we've seen the oil companies get compressed on the multiples, and gas companies have risen. But
yeah, the Appalachia, the gas companies, even Comstock and the Haynesville, with all the buzz around market data centers and AI, they're trading, very robust cash flow valuations, 6 times, 7 times. And, we've seen it in Appalachia that it has been cheaper to buy assets. So, we've seen EOG buy Encino. We've seen Antero, who's never bought anything, buy HG from Quantum. And then, we've seen of other deals, and that's sort of an arbitrage. It's been tougher on the oil side. Mm-hmm. I mean, the Permian mid-caps minus Diamondback, they're trading 3.5-4 times. Mm-hmm. And so it's been much tougher on the oil side, but there clearly has been a lot of accretion for the public gas companies buying gas assets.
Very interesting. So you guys, when you describe all this, you've got the ABS tool, the private equity, the international capital, strategic capital, and then some publics that would like to have more inventory. It sounds like it would be better to be a seller than a buyer in the asset market right now. I know that, it could always, who knows what the world, but it you probably don't want to characterize it like that, but how do you think about it?
No, it really, especially on the conventional side, it is, the market is biased to the seller. A lot of these buyers are, whether it be ABS, they're sort of long-term holders. But, everybody talks about the demise of the A&D market. It's been $60 billion every year. In the last 2 years, we're like, there's nothing left. And, we had 60 billion last year. We're probably going to have 60 billion this year. And, the markets are very efficient. The one thing that, I'll say that's really exciting about 26 is the best news for A&D is corporate M&A. Yeah. And there's about a 6-month lag time between a corporate M&A deal and a lot of divestitures hitting the market. And, if you look at all the deals that have done, with Conoco, Marathon, Exxon, Devon, Coterra, SM, we announced the SM deal today, Civitas, all those non-core assets will probably be hitting the market, in the next 3 to 6 months. So, I think this is going to be a very busy year, probably another $60 billion year. The one difference this year is I think the sellers are going to be more the publics that, are just sort of doing cleanup versus the private equity.
Fascinating.
What about, one of the things that I hear a lot about is the trading houses being involved on the buy side. Craig, do you mind speaking to that and what you see, from that, what they're thinking about, what their angle is, and what they're chasing?
Yeah, one's in your building.
Yes,
VTOL.
right.
But we've seen the Citadels, VTOLs, Trafficker, Gunvars, whatnot, because they want the physical commodity. So we've seen them. Some like VTOL have teams or have relationships with teams to actually operate the asset. They have an asset in Delaware that they operate with VTX. And so I think others are trying to partner with folks to try to get the actual exposure to the physical commodity. So that's kind of added a bucket of buyers you didn't really have a few years ago, outside maybe, VTOL has done this for a little bit. But it's getting exposure to that physical commodity. They obviously have a take on what that's going to be, and they're trying to exploit the knowledge that they have and maybe the asymmetric information they have versus other regular way bidders, and trying to be aggressive from that angle.
Is there unusual requests from them when they're buying, or is there any sort of conditions around that as it relates to marketing the product or anything like that?
No, because I think they're partnering with it. And again, from the unusual requests in a seller's market, unusual requests don't really go. You've got to kind of conform. And so I think folks, that's another angle, is that folks are trying to find a way, whatever they can do, to get attention from a seller to be the guy, given how competitive it is.
Scott, you mentioned the, going back not too many years, there was a lot of pressure to get capital in the sector. What do you see with commercial bank availability, revolver, classic bank borrowing?
During the height of ESG, all the banks pretty much pulled out of the bank market, especially in the U.S. A lot of regional banks, and they're back. And so right now, I would say over the last 2 years, every North American bank is back in the U.S. Energy lending business. Typically every deal now is almost double it, 2 times subscribed. So if a bank's looking for $100 million hold, they're scaled down to 70. So the commercial bank market is very robust. Pricing, SOFR plus 200. We're seeing tenors go out 5 years, 7 years. So in terms of capital, very, very attractive right now. Bank debt, 4 or 5% is not bad.
All right, it's the age-old question, and it almost never happens. But what about a go private? Do you think we might see one? Are the conditions lining up?
Well, there's certainly some interesting situations. Or in the Rockies, where you've seen some companies trade at 1.5, 2 times, and without going through names, there's a lot of calories spent on that. We talk about it all the time.
It seems to have the highest calories to actually happening
it's
of
neat.
anything ever.
The analysts and associates love it.
Yeah.
But yeah,
That
there's
and the roll up of the small caps.
yeah, we talk about leverage loosening, but there still are leverage constraints, and it seems if you just do the finger math, if you can't lever to sort of 3 times on an E&P basis, it's hard, and that tends to be sort of what's killing these deals. Will there be some go privates? Yeah, I mean Continental was sort of screwy when you had a chunky shareholder, in Herald. But we're especially with the small caps, we're looking at it, but I don't know. We'll see.
So we had I referenced it before. We had David Batt on yesterday, and he was talking about technology. And shale always surprises, and we figure out new ways to do things. Do you think are there buyers in your world today who clearly they attach option value to prices, of course, and inventory going up in value, but do you think there's some bets being made on just we're going to figure a way to get more stuff out of this rock? Is that a common belief amongst your buyers?
I think ultimately it is maybe under the tongue, if you will. I think what we're seeing just from quantitative and actual physically seeing is I think Scott may have mentioned this earlier, but right now people are trying to figure out how to be competitive. In a traditional market, most people use, especially private equity, use strip, and whatever comes out, comes out. Now you're seeing guys that are pushing all in because they don't see the next opportunity necessarily as clear of what is next. So we're seeing people, Scott said earlier, push harder, maybe a 2-year strip and use some kind of elevated flat price after that. We're seeing another knobby turn is accelerated developments, how many rigs you run, and then third is the inventory expansion. So in the old days or traditional market, I'd say you risk, you get full value for zone A and zone B. Those are 2 fully delineated zones. You get full value, you get C through Z as serendipity and all for free. You do that in today's market, you're going to be middle of the pack. And so I think what we're seeing guys do is, even though maybe you're squinting to see value on zone C, maybe zone D, is you're having to give some real value to those zones. Now, whether you think you can do it or not, I think it's ultimately a way you can be distinctive, hopefully, in your bidding. But I think with everything I've always said about our industry is when the market investors give us money, we torch it. Unfortunately, we torch it with the best of them. But when we're forced to do what we're a really smart industry, and those, whether it's EOG leading the way or some private equity or niche type player, those secondary zones that are today will be tomorrow's core because it has to be, right? Because there isn't. And so I think, well, I'd like to think we're a smart industry and we will figure it out. And we've always seen through the history of all of our careers, people have figured out what most people deem you can't figure out. It's just right now, I think they're having to do those things to win a deal. But I do think that they believe that our technology is only getting better. And those zones are, and you're hearing every day. You hear about the Barnett right now, which, you've heard about a little bit, but now it's getting a lot of traction in the Woodford and some of these zones, because that's where people are having to focus their attention because the easy stuff is kind of gone.
I think the boundaries have been drawn. So if you look at the Delaware, the Midland, Eagle Ford, there are boundaries. No one's going west of Colbert. I mean, 10 years ago, people were, going east and west, north and south. Today, the boundaries are defined. People are, though, giving credit to deeper zones. And, we're certainly seeing it in the Permian. The Barnett is now, we're producing from Barnett in the Midland, but people are valuing that. They've been valuing that for a couple of years. In the Eagle Ford, people are giving value to the Pearsall. So up to down, all those zones are given some value to. But if you look east-west beyond the boundaries, there's no value given to that.
That's really interesting. So what do you guys, in this environment, it's kind of frothy, like there's a lot of excitement. You got to pay attention to the existing basins. But what do you think about new basins and international, and how do you I mean, just how do you guys use your time in those things? Because
Yeah.
you've got a lot to do here, and you don't want to chase things that don't happen. Like, how do you think about?
Yeah, it's, interesting. Most of the basins are now 80-90% dominated by publics, with the exception of the mid-continent, which is still dominated by the privates. But, in terms of new basins, we talked a little bit about the private equity going into the deeper zones and leasing those. I think, in the Eagle Ford, we're seeing, a few new zones, but it's been pretty finite. I guess probably the most exciting has been the Haynesville, watching Comstock move west. And we obviously just saw Rockcliffe do a deal, seeing the Shelby Trough come back into flavor, but it's pretty darn mature. If you look at, we have a map that shows each basin on development. And the one area where you're still in the third or fourth inning is probably the Rockies. Looking at the Uinta, looking at the Powder, even the DJ. I think you're going to need a good gas price, but that's in the U.S. That's probably the next area, of development.
I think as a young guy, I remember people used to talk about the powder. It's always been, it was Brian Weiss had PRB, you got to believe, or that's dating myself. But do you think in this regulatory environment, are federal basins like that are people going to get more comfortable that they can go faster, and that'll be a reason to
No,
to
absolutely. Different views on the administration, whether it's good or bad for the industry, but definitely from a regulatory standpoint, it's good, and it's driving, a lot of decisions. 5 years ago, we really couldn't get more than 3 or 4 companies to even look at New Mexico because of the regulatory burden. Obviously, it's always had the best rock in the Permian, but people wouldn't touch it. Now, New Mexico is the single hottest. New Mexico side of the Delaware Basin is the single hottest basin in the United States. There's going to be
Is that because there's just so much to do over there?
Number one, the rock's good. Number two, people are taking regulatory risk. They feel very comfortable, with this administration. Number three, it's just, I think we're going to have a federal lease sale in New Mexico next month. And you're going to see acreage go for $200,000 plus an acre. And I can't tell you how hard it was to get folks to look at New Mexico 5-6 years ago.
Wow. Yeah. Okay.
And it's regulatory.
Unfair question. I'm buying something in the Permian, and I'm attaching some value to Permian gas. Are you seeing people change how they feel about the value of that cash flow stream, or is it still like?
No, it's again, really good, Permian sticks, $4 to $5, $6 million a stick. As we go deeper, we're getting more gas, and don't quote me, but I don't know if it's 35, whatever the residual is, oil, gas, NGLs. There's not much gas price right now in the Delaware. Is that impacting valuations? No.
Well, people aren't taking the view yet that
that's
could change.
Not yet.
Yeah, I think where you're at going is, so you got all this LNG and all this gas demand, and it's coming from the Haynesville, and then the actionable opportunities there are almost zero now. And then the next sort of source is the Eagle Ford, because it's right next door, and you see sort of like our deal this morning had a lot of gas exposure to it. And I think we're seeing, that's why Oklahoma started getting a lot of attention, because it's got a massive, people, the sins of Oklahoma that people have had to deal with parent-child have kind of gone away. People have figured it out. The publics haven't yet get on board. That's why you see a lot of them selling. But there's a massive gas resource in Oklahoma. No one will dispute that. You saw, I think Total did a JV here recently. So but Oklahoma takes a lot of geologic knowledge, a lot of land knowledge. So to come in internationally, it's a bit of a different animal in some of these other basins. And the Permian, like you said, has a massive amount of gas right now. You're not getting it priced. I think and we're not midstream guys, but our midstream group can answer this, but all the midstream build out that's happening. But I do think people are looking at that as potentially when the Haynesville depletes, the Eagle Ford, that people are seriously looking at the Permian for that. We just haven't seen people necessarily chase that at the moment as their sole underlying theme.
I agree.
Okay, I have an unfair question.
Well, then
And
ask
Mark-
it to Craig.
Oh yeah. Okay, I'll look this way. No, and then Mark, you can ask a fair question. But I was just thinking, let's say you had a $500 million ish package. I'm just kind of trying to pick something that's reasonably affordable. And it was vanilla, nothing too exotic. How many buyers are you going to attract? Like, how do you think about a process like right now? Is it
Why don't you quote unconventional and then conventional?
however you would try to
Yeah,
fill
I
in
think
those
a
blanks?
$500 million size deal is no longer
That's not
too
the right
big
sweet spot.
for most. I mean, I'm just saying that would be pretty broad, and you'd have, to be honest, you'd have 50, 60 plus people in, and I think you would get a dozen bids or something like that. But it goes back to the scarcity thing. There's a lot of dollars on the sidelines. There's a lot of private equity teams that don't have assets yet. So there is a deep bench on these. In fact, if you go upscale bigger, you're still seeing this suite of participants that we didn't see back in the day when these deals outsized a lot of folks. So
It's pretty incredible, isn't it? That many potential.
yeah, and I'm not talking, like I said, you go out to anyone. No one's ever said in my career that they couldn't do $1 billion deal. You never hear that. But
But
obviously
you have
we've
to go
done
back to the Aubrey days, where we were, getting 10 plus bids in a fly bid.
Yeah.
And we're sort of back.
I think what's really unique about this market is, again, a normal way traditional market is when you guys did this is you sort of have that bell curve and you run a process. You got the guys that just maybe are looking at different data or just fundamentally just don't know how to bid aggressively. You have the guys probably where the fair market value of the asset is in the high part of the bell curve. And then you're trying to find that one Aubrey McClendon, that one guy out there that sees it differently, distinguishes himself differently. In this market, we are seeing a group of folks that are in that normal quote unquote fly bid category. Because again, looking at the scarcity of things. We talked about the lean in from bid 1 to bid 2. And as a sell side advisor, being on sell side, there's no better feeling. That's when you truly know a market is hot, is when you have depth at that top group. We've all done this where we're dealing with one guy and we all have to have an amazing poker face, right?
But we
in
never say it's just one guy.
Yeah, that's right.
Very close.
That's our secret. But there is a depth here to where if somebody asked earlier, does someone have to do this or that? You have to, if you don't conform or you retrade or any of that, you can put a bullet, as old Steve Barr used to say, into someone, you move on to the next guy and you don't lose a thing. That is truly when you know there's a very aggressive market, when that bench at the top is deep.
Yeah, so you said I was going to ask a fair question. It's probably going to be unfair.
Okay,
So
all right, 2
I'll
in a row.
surprise them. But no, you guys do a really good job of understanding the market and where the capital is coming from, where the deals are coming from, and all of that. Y'all done a very good job of that for years. And we've talked a little bit about the ecosystem of the upstream space, but I'm curious to get your thoughts on, you alluded to, hey, we have this M&A dynamic that's just happened, and just like we used to see all the time, right? You see a lot of divestitures after that.
Yeah.
But as you look over the next 5 years, what does the RBC year-end review look like in 2030? What's happened to the publics? What's happened to private equity? What's going on, do you think?
The final four, now that we're
Right.
getting close to March Madness. We're left with 10 companies, public companies right now. M&A discussion has never been greater than it is right now.
Wow.
Maynard talked about, buying the asset market. But, looking, at the response on the Devon deal, I think you're going to, where you can announce deals with synergies. I think we're going to see more and more of that. And, I don't know who the final four will be, but you have to believe, Exxon, Chevron, or even seeing Shell come back,
Right.
to the U.S. So it's really going to be, the big guys. And, who that fourth person is, I don't know, but that's I
Wow.
think where we're headed.
Wow.
I have a little different pulse on that. I'm sure I'll be wrong, just like anyone that prognosticates
Right.
commodity price will be wrong. But the one little caveat I have to that is you see a consolidating industry for all the reasons Scott said, and I think we'll continue to see that. But I do feel that ultimately we've seen our career as a company gets bigger. I don't care who you are, how good you are. You get a little fatter, you get a little sloppier, you get a little slower, and that's what private equity and others are for, because that food falls down. And I do think that I'm not advocating here that it's time the IPO window's open and go do it, because we've all talked about that. I used to say sub $10 billion, you're irrelevant. Now I'd argue sub 20, that seems to be ratcheting up. But I do believe that, like what Parsley and Diamondback in the old days and Athlon exploited in the IPO, is they did things really nimbly. And I think investors ultimately like that. I'm not trying to make some call on something. I'm just saying the circle of our industry, you're going to have a lot of big companies, that just can't handle everything, or have to prune things off to other very nimble people, which we've always had in our industry. And I don't know whether it's through IPOs. I'm not saying we expand 80 companies again, E&Ps, because there's probably not enough room for that. But it feels like there's enough to do to keep a lot of folks busy.
Yeah, again, I think there's going to be fewer publics, but I think that's going to be great, for the privates, private equity.
Yeah.
And create even more opportunity.
Yeah. Sure.
This is like my favorite question these days on almost anything. But in a data room process, are you seeing buyers, or is somehow you or the seller utilizing AI to quickly run scenarios, to make the bid process go faster? Like, is AI entering your world yet?
I haven't seen it on the bid side of things, or just the evaluation. I'm not really sure. Someone has a good bid, I don't ask them how they got there. I mean, but
can you trust ChatGPT to bid? I guess would be the question.
ChatGPT, it'll spit out the right answer. But I don't know what I hear more about AI, and I can barely spell AI. I'm just not an AI person. I don't know how to use ChatGPT or any of that. But it feels like more we hear it on the operational side. A lot of folks are incorporating that, obviously, in their own operations daily. I don't know if that has been helpful in the evaluation process. My guess is it's been helpful everywhere else, probably somewhere in there.
Are you finding in this market, which a lot of interested players, the processes are just going a lot faster?
Well, I can only speak for our process. Well, we're on the buy side and others. I don't think they're going faster. I think people always would like they want 30 more days of production. They love 2 more weeks but in this market, someone asked me the other day, do we need to be concerned about another deal kind of similar timeline? I think I used to say deal competition is a bigger destroyer of value than commodity price, because you don't want to dilute your buyers. And that was when you guys were doing this, there were 200 deals out there. Right. And if you missed this, you went on to 50 others. Now you don't have that luxury. So people have the human resources to allocate to the only 1 or 2 deals. They're not working 20 deals at a time anymore. So we try to build in something to where, oftentimes, especially on bigger deals, we don't like to put a bid date, because we like to be thoughtful around talking to people as they work the data. If one person who's always going to cry uncle and say, I need more time, you don't revolve around. But if the majority of people are telling you want to be cognizant of that. But generally 4 to 6 weeks. Again, if you have international players, you want to recognize that. We ran a process for Geo Southern where we knew that was going to be a big part of it. We needed to adapt to that and make sure that we didn't jam them too hard. We got to them early, so they had things ahead of time. But I don't really see it. I think people have the ability, because they're not working a million other things, and because there's such a need, people will complain, but they're going to get to that timeline.
What about, we had a friend was telling us about just the interest in continuation vehicles. Mm-hmm. So if you have a private E&P company that for whatever reason you're not getting the value you want, or whatever it is, it's fund management. Is that feature of today's world affecting anything in your market?
It has. We've seen, private equity for years really didn't want to do continuation funds. It was sort of a negative. But, as you said, over the last 2 years, we've certainly seen it in Appalachia. There's probably been 4 or 5 portfolio companies where they've done continuation funds. And we're, as advisors, we're like, this is an enemy. This is not good for us. Normally, we would be getting hired and getting paid for the fee. But again, just highlighting this A&D market we're in, we're starting to see, we saw a deal in Appalachia that was bought by a strategic that, outbid the continuation fund option. So they're going to still happen. But it's pretty competitive right now between the A&D market and the Portco doing the continuation fund.
Yeah, I'd say that we got a little nervous a few years ago when the ABS product, where people said, well, we'll go through a process. If we don't get our number, which is usually the expectation is really high, we'll go do this ABS. Well, a lot of people found out that that's not necessarily the answer for most assets, right? You need to have certain characteristics. So we got a little nervous there when people trying to do it, but that didn't really work out. Now the buyers are able to do it. They'd rather shift that burden to the buyers. And then the CVs, the continuation vehicles, started to be an issue. As Scott said, is all of a sudden you're going to run a process to do a check and just do a continuation vehicle, right? No one wants to do this for the practice. But the market has been so strong that most have been able to capture their valuation as stands. But to the extent there are things, and there's been a handful that made a lot of sense to do a continuation vehicle, and that has worked. But a couple instances quickly, maybe after a year or something, again, the market's been so strong, it's gone to market, sold. So I think the continuation vehicle will still be, certainly, I don't want to call it a threat, certainly an option for folks, but it seems in this kind of market, it's been less of a tool to at least take money out of our mouths and shift from a process to a continuation.
This is nerdy, but is the not that the whole thing hasn't been, but do you ever include, is like the continuation vehicle almost participating in the process? So in a way, it's just another option, or is that, you think of it as
ABS
afterwards?
Yeah, I think, not really. That's really an after effect, if you will. I think not that this is the question you asked, but to Scott's point, ABS, that's a super big threat to folks. And again, as good sell-side advisors, we like to have that threat in there. People know it because it is real. And it's been more that's during the process versus a continuation vehicle really is.
Yeah, continuation funds, they take a long period of time.
Yeah. Different investors.
Yeah.
But do you ever have a public company say to you, geez, I could just I don't know if I'm necessarily selling this, but how do I just tap into the ABS for me and keep the upside somehow? Is that a trend where people wonder about that?
It goes back to the partnerships. Like Diversified is public, and they actually do it, and they've done it, many of them. But most of the publics are not interested in doing an ABS and getting into that business. They would prefer to partner with an ABS guy. That ABS guy takes the bulk of PDP, and maybe leaves a little bit for the public, and they take the bulk at the end of it.
But you can't do it as like, I just want to mortgage my own property and somehow I'll put it in a separate vehicle.
That's what Diversified does. Most public E&Ps that we have said don't want to do that. Again, Diversified, their skill set is those types of assets. So it's most E&Ps, it's growth and inventory.
And is this ABS thing still here 5 years from now? Or is this just a period of time?
I know a lot of private equity is cursing ABS right now, but I think if it's managed right and people don't destroy it, like I said, the MLPs where we got in trouble, and I always say the stories like in 2007 when Will and Mike Lynn announced Lynn Energy and the MLP. I remember him saying it was $300 billion of mature assets in the U.S. And I thought to myself, that's right, but 90% of those are trapped within Exxon and Chevron and Conoco, and they don't come out to market every week. And so what happens is when you need this and you don't have it, you need something, you start buying things that maybe are a little out of the wheelhouse, and that's where things got into trouble. And I think that would be the thing if ABS starts doing those types of things, and maybe it does start to have problems later down the road. But
these products typically last, anywhere from 18 months to 2 years. Who knows? But my guess, your question was 5 years. Probably not.
And the participants in that market, is it like 5 insurance companies, 10, 100? Like how deep are those? Any sense of that?
I don't have a sense of the number. It seems pretty deep and getting deeper.
20 to 30. And our question is, what is the capacity? We've seen $10 to $15 billion of these deals done, and we're yet to see what the capacity is. The response we get is it's infinite. I don't believe it's infinite, but it's amazing. 15, $20 billion of assets financed with ABS. And if you look at the $15 to $20 billion of assets, it's really been 2 or 3 companies, that have done the majority of that.
One thing I'm really struck by is you alluded to it early on about the preempting is back. Just a few years ago, it felt like when you had a process, there was a floating bid date, right?
Yes. Yes, please give us the timeline.
Exactly. But it sounds like
FOMO. It's the whole scarcity thing.
Yeah.
And, I think out of the last 10 deals in the overall, A&D market, I think 4 or 5 were preempted.
Wow.
Big deals.
Wow.
So that's sort of new.
Yeah.
I mean, it's old, but it's sort of new.
And that's why sellers want to sell right now, because you can set a bid date. You have, I guess, certainty of execution and value. Of course.
280 gas, oil, and people are really wanting to sell because of the scarcity.
Yeah.
I mean, you guys did preempts, and they're really hard. They're difficult. I never drink the Kool-Aid, but I think one of you guys hit it is, hell, gas is probably more volatile. Oil's always been the volatile commodity. I'd argue gas is probably that right now. Gas you can always set your watch to, but that volatility, when you look at the risk, the market risk, execution risk, commodity price risk, and now M&A risk. So if you don't, if you wait, does a Devon Cotera happen and you lose a buyer? And so I think that is all playing into factors. I know we've got 2 days of preempts, and they're wonderful. You can get them done. But generally speaking, I still think that the demand is so great that there are certain instances where a company wants to probably mitigate that risk. I think the bigger company you're probably less inclined to do a preempt, because, again, you have to do it really early, because once you start seeing a lot of interest, the seller, starts seeing it. I still think they're difficult. I know it looks easy to pull off this week. I still think it's difficult. I think a lot of people will be driving to do it, but there's just so many different buckets of buyers right now. If you get that one, you can always tell a number that's just to stop the process type deal. But I still think that's still more. I differ, Scott, a little bit. I think it's still a little bit more unique size, not like something you're going to see weekly.
So here's a curveball, guys. If a U.S. guy was saying, I really want to go to Canada, look at all that inventory. I got to think about my next decade, what I'm doing. How can they? Because a lot of people have tried it over the years. It hasn't always worked out, but it is a place with a lot of upside. How would you advise people to figure out Canada, particularly a U.S. player? Yeah,
so obviously a lot of bad cross-border deals done in the day, and it was just driven on gas price. I would say,
is that where people got it wrong?
I mean, there's some other social issues as well, but it was really being on the wrong side of ACO. I think what's changed now, you got 2 plays up there in the Montney, in the Duvernay, that are as good as any play in the U.S., and we have 3 and 4 years of production history. So the technical intelligence is out there now, where it wasn't, in the 90s and in the 2000s when Anderson and all those deals were done. There's still some differences, but ultimately, I think we're going to see guys that have sold out of Canada go back, and we have data rooms right now in Calgary, in Australia, and it's all U.S. domestic public companies. We, Oventive, in Canada in the day, we laughed when they paid $30,000 an acre for Athlon. You may have been involved in that one. Timing wasn't great, but ultimately, it ended up being the best asset in Canada had. And Canada really, still very much interested in the U.S. They just did a deal back in the Montney, with NuVista, and again, they did sort of a compare and contrast the economics, and the economics, were favorable. So I just think there's again, we're based in maturity. We know the type curves. I just don't think there'll be the technical mistakes that there was. And, I do think in terms of getting pricing at gas points beyond ACO, there's things you can do now that will, lessen your commodity risk.
And one thing everybody's been paying attention to the Vaca Muerta. Obviously, have some new developments going on with Venezuela. We've been getting into this slight narrative about the relationship with Latin America is changing, and maybe people should think strategically about Latin America. Are we getting carried away there, or do you think, are you sensing any people looking again, thinking again, debating again?
Mostly, it's interesting. This, Venezuela thing was really interesting. I think the knee-jerk reaction was, oh my gosh, there's going to be so much capital, so much production coming from Venezuela. I think there's 800,000 barrels a day right now in Venezuela. There was a meeting in Washington with the CEOs. I'm not sure it went the way it was scripted. I still think, at least with the publics, there's still some hesitancy of spending, capital. Obviously, the infrastructure in Venezuela is going to have to be built. It's a very, very heavy crude. If you did have the capital, we'd go from 800,000 barrels, maybe we get back to 2 or 3 billion barrels in 5 years. So Venezuela, we'll see. But the private guys have been the ones that have been super aggressive in South America. And, we've, obviously, seeing, Brian and Harold Hamm and seeing, Jeff Hildebrand. We're seeing a lot of the private guys, being much more opportunistic. Of course, they haven't been nationalized. But we see more appetite, from them. But the publics are all looking for big exploration plays.
So on that point, the exploration side, it feels like a lot of E&Ps, obviously EOG has had basically, the organic growth model for a long time. But a lot of its peers do not. They moved away from that. And they moved out of water, they moved out of exploration. Are they going to have to start thinking about that going forward?
I absolutely think so. And if you look at all the large caps that are 10 billion or higher, even if their assets are 100% domestic, right now they all have special international subsidiaries, as you know, and they are, they're willing to spend, 10, 20% of their capital on international. And, it'll be interesting to see, everybody was sort of poo-pooing Apache with, Egypt and Suriname and Alaska, but I almost see the industry moving more that they're going to have to, right?
Yeah. There's a few companies like Murphy, for example,
that historically,
kept that capability.
Yeah, that was actually my question. Anything you'd add on international shale?
I'm a domestic guy, so I stay within the borders. But what I see is, I know a lot of
in
people
the Louisiana Purchase, like
exactly.
kind of,
Just
like
Texas.
Marcellus is okay.
But I'd say just we've introduced or reintroduced more folks to our Canadian team in the last 18 months than we have in the last 5 years. Wow. And a lot of these people that have been burned in Canada. And some of it's educational, some of it's re-educational, some of it's first inning, some of it's really 6th, 7th inning and prepared to do something. But all stems back from there's not much left in the lower 48. So people you asked about new basins, don't really see the new basin stuff necessarily. I mean, people are maybe digging a little bit back in the powder and some things that have been left for a while. But it is Canada, it's international, is where people are going. Scott said, we've got a process we had in Australia. Again, some of this, I want to say tire kicking, it's trying to get education because they recognize this may be the future and we can't ignore this, and we just can't go into the Permian anymore and just buy up what we want. We have a really cool map that we show where if you look at 2020, the Permian, some of it was yellow being public, some was blue being private and private equity. You look at today and some is all yellow. So it's all public owned. People recognize they got to find other places, and that's where you're seeing the biggest. So I couldn't, I wouldn't dare venture into how good any of these plays are, but I know, some of our private friends are looking at Libya and places that you haven't heard for 10 years.
I think they're getting really smart in 26. I think you'll start to see more things actually happen in 27, 28, but everyone's getting really smart.
That's interesting. Did I hear you right? You said Greece?
Greece.
Yeah, let's talk. That's a beautiful place.
Libya,
we all need to go to Greece.
Eastern.
I mean,
it's it's amazing. But I know a lot of what y'all do is international consulting, so I'm sure you're seeing it. But it's a fun time to be in the industry. Industry's healthy. So I hope we don't go to $2.20 gas. We've talked about how resilient the industry has been, but people are fairly bullish and very comfortable about where things are right now.
Well, guys, it's fascinating. We pummeled you with every question we could think of. We really enjoy it. I hope you enjoy the rest of your NAPE. Any plans? Any cocktail hours we got to make sure this guy goes to?
I wish I had equity in the Four Seasons Houston right now.
I don't know. Depending on how this goes, people want to see us. You bashed us, so you owe us a drink, or you propped us up. We'll buy you a drink.
We definitely owe you a drink. If you watch this, buy these guys a drink. Craig, Scott, thanks so much for joining us. Thanks, everybody. Enjoy NAPE.